If you're an engineer, an architect, or in construction, you've probably used AutoCAD and know the company Autodesk, who actually has more than just that one product. Today, we'll be discussing a little bit of an overview and history of the company and how they've transitioned to more of a subscription model, as well as my opinion on the stock itself. The company was founded in 1982, and their main focus is 3D modeling. They do have different segments that they target: architecture, engineering, construction, followed by product design and manufacturing, and then they are getting more involved with the media and entertainment space as well. When I was a senior financial analyst in the manufacturing environment, I worked with a lot of engineers and they used AutoCAD. We'd be working on a project worth $30 million on a new manufacturing line, and they'd be using AutoCAD to map out within a specific area how the process flow of that machinery and line would operate and see if there was going to be any issues. What I do love about this company is that it has my favorite business model, the subscription model, software as a service, high gross margins, and if you go into their products, we'll see that they offer a subscription-based plan, whether that's monthly, you get a slight discount if it's annual. They also have a flex option, so if you need to use software on an hourly basis or for a small job, you can do that as well. And the fact that it's subscription-based means that once they reach a certain level and they're covering their fixed costs, this company becomes a cash flowing machine. When I originally looked at this company, it was around 282, currently trades closer to 264, but overall the company is a larger cap company with a $58 billion market cap, definitely being valued as a growth stock. I mean, we are talking about a company with a 5-year revenue growth rate expected to be around 14.6%. Speaking of growth, the company sees two avenues towards continued growth. One, the digitization, it's a hard word to say, for the older industries that we're talking about, architecture, engineering, construction, and then they also are targeting legacy users because they did go through a transition period, moving to software as a service versus just selling it out of a box and saying, hey, you can download the software and then just use it forever. And during those years, as they transitioned to software as a service, there were some growing pains, switching people over to this product. A lot of investment went into this, but as soon as you have people that stick around, have that subscription and get used to these cloud services, in 2019, we started to see an increase in total revenue, and then also the profitability of the company skyrocketed. We also see that the stock, like this move to SaaS over the years, this giant spike, and this chart looks very similar to Adobe. I mean, look at this thing. It also transitioned more to a software as a service business, and they also had a huge spike. I also want to briefly mention net retention rate, which isn't specific to Autodesk. If we're looking at SaaS companies in the future, or if you're looking at earnings reports and you see this metric, I just want to briefly talk about what this means. There's 4 components to it: monthly recurring revenue, expansion revenue, revenue reduction, and revenue churn. It's simply just this formula to figure out how many people within their customer basis is actually upgrading services to expand their recurring revenue, making sure that they're maintaining their customer base so they're not losing a bunch of people via churn. Now, my favorite part, diving into the financials. 2 things jump off the page for me. Gross margins above 91%, which is extremely high, which leads to higher profitability as they can keep their fixed costs stable. Also, the fact that their revenue source is actually 97% recurring. Also, have a good NRR, or net retention rate. Any new customers that they're adding, they can just grow their revenue and free cash flow. They have a solid base. It shows on the balance sheet as well: $1.9 billion in cash, and in the past 12 months, they've generated $1.4 billion in free cash flow. One negative that I did notice was that the book value a few years ago was in the negative. It seems like it was during that transition period. Lower the retained earnings to a negative point. You see minus $2 billion here. With the turnaround, the trend is going in the opposite direction. They're building equity. In terms of revenue mix, the majority of their income does come from AutoCAD, as well as architecture, engineering, and construction. What actually is a little surprising is that their makeup from a geographical perspective is pretty even across these different regions. They're actually a pretty global company. I also wanted to see how they traded versus their peers. So looking at some multiples like EV to EBITDA, comparing them versus Adobe, as well as these other companies that are somewhat similar. Autodesk trades at a slightly higher multiple for EV to EBITDA. Price to sales ratio, they're more in line with these other companies, but then their growth rate maybe isn't as fast as someone like Adobe. So having a slightly lower price to sales ratio makes sense. What is nice to see is they are the top dog when it comes to gross margin, obviously a positive. Looking at their last earnings report, they did give us guidance for the next quarter as well as the full year. We can use that in our DCF to kind of get a base for the years going forward. Right now, they're projecting projecting a full year revenue of close to $4.4 billion. And then we're talking about free cash flow of around $1.5 billion. Based on some assumptions from that outlook, as well as some guidance from websites like Finbox related to revenue growth, I come up with a projected fair value of around $223 using something like a 12.5 price to sales ratio as well. With the current stock actually trading a little lower than this 282 number, there's still some downside in my opinion to the fair value. I think part of the premium that is built into a stock like Autodesk is because they have such a high margin that maybe it is fair to give it a little bit of a premium. But if I just look at the assumptions that I'm putting in and just the free cash flows that are backed into a present value and the current market environment that's putting pressure on growth stocks, it's still a little pricey. As for Wall Street, they are still bullish on the stock, and we have 13 ratings on the stock with an upside target around 343. Wall Street still likes the stock. For risk and ops, I see one risk of the growth kind of plateauing at some point if most of the revenue is still coming from this segment, architecture, engineering, construction. I know there's digitization within the industry, but in terms of explosive growth, I think one of the opportunities that they should lean into a little bit more, 3D modeling related to the metaverse. I didn't see anything too much from the company itself talking about focusing on this, but with the metaverse, this is a total addressable market that is expected to really explode in growth versus something like that AEC target addressable market is a little lower. So if they do transition to the metaverse, that could be a huge upside for this company being able to tap into higher revenue growth. In conclusion, I definitely like this stock and I like this company, so it's on the watch list. And if it comes down to a certain price with a company with that high of gross margins, and if the multiples make relative sense, this is something that I could see myself adding a little bit of a position. I already have something like Adobe in the portfolio. Love Adobe. This would be a little bit more focused on 3D modeling itself. There's my review on Autodesk. Hopefully you learned a thing or two. If you did enjoy the video, make sure to hit that like button and subscribe to Main Street Wolf. Thanks guys for watching and have a great day.